Hi guys, so welcome back to the channel. Sorry guys, I was supposed to upload this video earlier today, but something came up that needed my attention. But here we go. So I'm reviewing a trade that ICT took yesterday, and I also took the same trade. Basically, it's actually my first time using his model. Okay, and so here we go. So let's say, for instance, we have a buy side liquidity and we have a sell side liquidity, and we understand that when price takes a swing high, breaks a low, we are going to look for an entry right here, somewhere here, FVG or an order block or a breaker, whichever you look for, and then we are going to target the next pool of liquidity, which will be the buy side right here, the sell side rather, right here, and we will sell into here. Okay, so now there are two things that I noticed that ICT does. Sometimes he doesn't take his trades right here. Okay, he's going to look for an entry in here, a continuation from here, and his target will be the next pool of liquidity. Another thing that I noticed, and I mean from here, of course, let's say if this is M15 or M5, he's going to switch to M1, and then what he does is he looks for he enters with FBG. Let's say price has been going down, M15, he switches to M1, and then when there is a fair value gap created, price goes back into it, and then he sells from there. Okay, but then what I'm going to show you is, let me show you. Let's say, for instance, price has been, I'm not going at good at drawing, but let's see. Let's say price has been going up, making highs, and then suddenly we reach here, price doesn't take any liquidity from here. We break a low, and then suddenly price is going down. Okay, that's the first scenario. Let me zoom in. That's the first scenario. Okay, so now let's say at this point, price, let's say we price is almost I mean the New York Stock Exchange is almost opening, which is at 9:30. Let's say, for instance, this is Nasdaq, and then 9:30 opens right here. We understand that because of these structures, price is going to come here in this structure, and then we'll continue printing the same thing until price takes this liquidity. Then after taking this liquidity, we anticipate that price is going to come for this buy side liquidity. Okay, so basically there is no buy side taken and there is no sell side liquidity taken, but then price can show you which liquidity pool is going to be taken first, either the buy side or the sell side, and then what will tell you that is market structure and imbalance or fair value gaps. Okay, I'll show you another example. Let's say price has been consolidating in here, has been consolidating. Okay, we don't know, has been consolidating here, and we don't know if price is going to attack this buy side or if price is going to attack the sell side first. Okay, So what I've noticed ICT does is that he will wait for the opening, the New York Stock Exchange opening, and obviously price has to break out of this range. So if price breaks out of here, okay, and then he switches to M1, and M1 is printing, gives an entry based on the fair value gaps. He waits for price to come and tap in that gap, and then he will target this sell side. After this sell side has been taken, price will reverse, okay, and then we'll start printing structures to target this buy side. So simply what I'm saying is, if there is no liquidity that has been taken, FVG in market structure can give you an idea to which pool of liquidity is going to be taken out first, and I'll give you a better idea on the uh, trade that was taken yesterday. Because I'm not good at drawing, guys, and I'm sure some of you are already saying, well, I still don't understand what you are saying, but I hope with this it will make sense. So this is yesterday. This is on 1 hour time frame. Let me switch to M15. I want you to look at this, and this is exactly what I saw. We have this pool of liquidity here, which is the sell side. Price hasn't taken it out. Then we have this high that price has not taken out, and this is a few minutes before the opening of the New York Stock Exchange. And then we also have this high that price just took out. Okay, so now we have this high which was created yesterday before market closes, because this is yesterday. I mean, this was the previous day, and this is yesterday. Okay, so price has taken this buy side liquidity, which is an old high. Okay, this is a swing high. It's not either previous day's high or previous day's low, because this is the previous day's high, this is the previous day's low. Now we should be selling, but then if you look closely, you'll find that let me print one more candle. Yes, now we need 30 more minutes before the New York Stock Exchange opens. So now I notice we have a fair value gap in here. A fair value gap. Okay. And then this bearish candle, it is the order block. So we have an OB. So we have an OB and the fair value gap. Okay. But then I asked myself, if we have taken this liquidity and then we have this break in the market structure, because we have a swing low, a swing high, then a swing low, so we need another swing high before we can break this low, right? So I measured from this swing low to the swing high. Is the market in premium? I don't know for you how you use your fibs, but this is how I use my fibs. I asked myself, is price in a premium for me to look for sales? No. The only way I can look for sales, price has to come in here. In here, I'm sorry guys, somebody's calling my phone. I need to switch it off. Just a second. I beg your pardon, guys. I forgot to switch off my phone before recording this. Bear with me, friends. Bear with me. Okay, all right. So I need a price to come up here for me to look for sales. So it's either from this premium level, it's either price does something like this, and then I sell. Okay, why? Because if I have a break in market structure, I can show it to you on H1. Can you see it? If I have a break in market structure like this, I don't need to wait for price to take this liquidity. However, if price intends to take out this liquidity, then there will be no need for price to print this type of a structure to sell. But if you take it, there is a high probability that you can sell and price goes your favor. But if it doesn't print this, then price has an intention to take out this liquidity. Okay, so for me, I was looking for buys, at least price to come above this zone, either to see a smart money reversal in this area, or price to take out this liquidity and then to sell. One of these two needs to happen. So now I was like, okay, so if New York Stock Exchange opens and then we tap into this fair value gap, maybe we touch also the order block, I can do what ICT does so that I can target this sell side liquidity or price to get into premium. Let me repeat that. If New York Exchange can open, we tap into this fair value gap, we touch the OB here, the order block, I can go to M1, which is ICT's model actually, and I normally don't use this model. It was my first time because we don't have any liquidity taken yet here. So we don't have a bias to go up or go down if we are basing on liquidity grabs. We don't know if price is going up or down. If we are going to buy, price had to take out this sell side first for us to target the buy side, but none of them has been taken. But because price is not yet in premium and I have a bullish fair value gap, a bullish order block, that tells me price is still buying until we reach the premium. I hope you understand that. Okay, so now I'm going to switch to M1. I'll print one more candle. I'm going to switch to M1 so that you can see what happened. I'll print one more candle for the New York opening. Here we go. There you go. You see, guys, we filled in the imbalance and we touched the order block and we rejected, price went up. But now let me switch to M1 so that you can see how the trade was taken. Okay, so I'll remove more candles maybe here. Okay, already you can see now when you switch to M1, it's gonna confuse you first because now the imbalance has disappeared. We have one here which price filled, then we have another one here. But since you are inside a higher time frame fair value gap, don't move anything. Any of the annotations, don't move anything. Just leave it the way it is. So there we go. There we go. Okay, now this is the New York Stock Exchange open. There we go. I'm still waiting. What am I waiting for? I'm waiting for price to come and fill this, okay? And then to give me an entry on 1 minute. This is 1 minute because I already understand the price has to buy and to take out this high. This can be your first target, this high, but I haven't made my entry yet. There we go. There we go. All right, so now I want you to see this. I'm gonna zoom in. Now price has gone below the previous bearish candle, and at the same time we took out the high of this bearish candle. Okay, so now I had my buy stop right here, and my stop loss was below here, and my target was right here. Not this, not the buy side liquidity. The reason is we have a break in market structure on H1, so there is a possibility that price can fail to take out this high, but we could come into premium and then to sell. So what I did, I put my take profit just a little bit above this zone. But the first for those who take partials, I don't take partials, but you could take your first partials here and then hold. Okay, so let's see now what happened. My stop loss was down here, and now there we go, and then I was out. And I think ICT took his entry on this candle right here as well. No, I think on this, the third bullish candle. That's where his entry was, I think. Okay, so now let me go through it again. No, to summarize it. So the first thing was we didn't have any liquidity taken for us to target the opposing pool of liquidity. We actually had a break in structure, but then we had a fair value gap and an order block for bullish. Now if we have a bullish order block and a fair value gap, and we have a break in structure, these are opposing each other. How? Because the structure is telling us that price is going to sell, but before selling, price is telling us that it's going to buy. All right, so I'm buying into the premium, and if time allows and price prints a template to sell, I will sell into this pool of liquidity. So now if I finish the whole of it, let's see what happened, and then it's taken out. There you go. There you go. There you go. Until the next day. So I normally don't use this model. And the funny thing is, if you go to M1, let me show you, you would still find more trades, because this is actually how I notice ICT trades. I'll show you. He actually opened another trade somewhere here. Let me look for it. Let me see, M2. Just hold on. I'll show you guys. Yeah, for example, we have a fair value gap here, but price doesn't come into it. It's okay. We have a fair value gap here, like that. Then price comes into it once and twice, and then price continues going up. All right, we have another fair value gap here. Price comes into it and price continues going up. But now I do not recommend, after price has taken out a high, do not chase it all the way up because you have no target anymore. Let me repeat that. If price has taken your target, do not chase it because you do not have any more target. If you are buying, to which buy side are you targeting? But if you look for buys from here, you are targeting this previous day's high. Okay, so I hope that this video has made a difference. Maybe I should just give you one more example on the US 30. Yeah, because I also took US 30, both of them actually. I took both of them. Since it's on a demo, I'm not trading until January, so it's the same thing. Okay, this is the same thing. If you could see this candle, this is the New York Stock Exchange opening. We have fair value gap and order block, and then this one, the target was this high. Okay, now the good thing with US 30, we had already taken previous day's low. That means price is no longer interested in coming down. We're actually going for this high. So now this candle came down into the fair value gap. Now switch to M1. As I said, I don't use this model, but I see to use it so often, and I was like, let me try it out. Okay, now we have a fair value gap. Oh my god, not this. We have a fair value gap in here. Price doesn't come into it, but we have this fair value gap here, and then price filled it. That is a good entry. We have another fair value gap here. In here, price comes into it. That's an entry. So my first entry was actually not on this fair value gap. It was on this candle. When this candle dipped below and this one took out all these highs, the next candle that was retracing here, that was my entry. And my second entry was into this fair value gap, and the target was up here. So thank you so much for watching this video, guys. Let me know if you have questions, or let me know if you want me to go deeper into this model, because I don't know, because so many of you are requesting me to talk about the prop firms, and I've been promising to make videos about prop firms, but I think this January I will start talking about prop firms and how you could pass them, and how you could protect the capital so they could keep having some withdrawals. And so enjoy the holidays. Happy New Year to you guys. Spend time with your families, and God bless you guys. Until next time, take care.